In this video, we are going to unpack the performance of All Star using the dashboards that we developed in our last discussion. So here were the dashboards. We had RONA consisting of profitability from the operations multiplied by the activity. And for return on equity, we had three components: profitability after tax multiplied by activity multiplied by leverage. So we're going to apply those to All Star. As a reminder, when you covered the context of business a little bit earlier on, I would have spoken to you about different sources of capital, and we would have covered how we get some money from shareholders, and shareholders have this expectation historically in South Africa of a return of 18% per annum based on the Johannesburg stock market performance. And a historical view of the cost of debt in South Africa, where the repo rate would have provided us some information, and at the time the repo rate I used in the discussion was 10%. We were able to determine a cost of equity and a cost of debt. And when we put these two together in this proportion of 70%, 30%, which is considered the ideal capital structure, we got an average of around about 15%, which represented our cost of capital. Now we're going to cover this in more detail in an upcoming video. But what I wanted to present here was two specific numbers. One, this 18%, which is an expectation that shareholders have in a South African context, and this 15%, which is what we might call a weighted average cost of capital for the business. And I'm going to show you where those come up in a moment and why they are important. So what I've created here is a very simple layout for you to go and find some formulas or find some components that we need to do the calculations for RONA and ROE. So this 23% and 41% is the answers to RONA, and we can see that RONA has gone up by an amount of 18.5%. But I want to understand what is causing RONA to go up. Is it the operating profit or the activity or a little bit of both? So your task is to go and find these formulas. Correction, not the formulas. Go and find the answers to the operating profit and the activity in this year, which is the 2017 year, and get the numbers for the 2018 year. And likewise, go and find the answers to the profit after tax and the activity and leverage so that we can calculate the return on equity and understand why this number has gone up. So if you want, stop the video here now, go and get those components, and then when you come back, we will explore what's gone on in the performance of the business. All right. So let's see what's happened here. We're going to start with RONA. We know that the 23% has increased to 41%. That's a healthy increase, but we want to find out what has caused this. So let's start by looking at the operating profit. And here you'll notice that the operating profit went from 4.75% up to 14.58%. So that's a substantial increase in operating profit from one year to the next, and therefore I used a nice sized upward arrow just to describe how that has increased. During the same timeline, the activity ratio has declined. Now remember, the principle behind the activity ratio is that we want it to be as high as possible, and it represents efficient use of our assets. What would cause the activity ratio to decline is an increase in net assets in the business that is bigger than, or proportionally bigger than, an increase in the sales. And in this case, what has happened is All Star has invested in new fixed assets to produce mattresses. It also has more working capital on its balance sheet, so therefore the activity ratio has declined. However, the increase in profitability has a stronger upward movement or upward pull than the decrease in the activity. Therefore, the return on net assets has gone up. So we could say the primary driver of the increase in RONA in All Star is because of this increase in profitability. Now, if the cost of capital in this business was 15%, that would represent the expectation that we want RONA to be greater than 15%. And in this case, it's no doubt that the performance in All Star is certainly exceeding a kind of average cost of capital for a South African business. Now, if we come and look at the return on equity, we know this has gone up, but now we're looking at three different components. The profit after tax has increased, the activity has decreased. Remember, this is the same activity as we used before. And the leverage has gone up quite substantially. So I've used a large arrow here to represent the increase in debt in the business. This is the R1 million loan that the business took on. Now, if I look at the increase in profitability and the decrease in activity, it looks to me like these two almost cancel each other out. Therefore, the increase in return on equity in this business has been brought about because they took on more debt. Now, just saying that sounds strange, I'm sure. How can you increase the performance of a business by taking on more debt? Well, you can do that because ultimately you have less equity. So therefore, any profits that you made are being measured against a lower equity denominator in the formula. Now, the riskiness of this business has increased. Adding more leverage to a business adds to the risk. However, in the short term, they've definitely been able to overcome that risk by increasing their profitability and therefore getting a large increase in the ROE. And if in South Africa shareholders have a long-term expectation of 18% as a return, well, we can clearly see we've gone from 15 to 42. The shareholders in this business are going to be very happy with these returns. So what we've been able to do here in the context of All Star is to use our dashboards to uncover the drivers of performance. In an upcoming video, we're going to do this for a listed company.